Hey, everybody, September 24th, the market update desk with Scott Riley, NMLS 157524. Got a little bit going on today, some news information coming out of China, multiple Fed members speaking. Let's kind of run through everything and see how it's affecting the market. So, early today, China did something the market had wondered when they were going to do. We knew they needed to do a stimulus package specifically around real estate because that is the main driver of individuals investing portfolio is real estate, and they've had a lot of problems with real estate. So let's kind of go through it here. Made a whole bunch of notes. So the People's Republic of China announced several measures to, like I said, to do stimulus. They include, but are not limited to, um, cutting the reserve requirement ratio, which frees up an estimated 1 trillion yuan in lending, cutting the 7-day reverse repo rate, slashing the average interest rates paid on existing mortgages by 0.5%. That's a big one. Lowered the minimum down payment to buy a home to 15%. Think of that in relationship to us, where we've got zero down, 3%, 5% down. Their minimum is now 15%. So much more strict than here in the States. They created a half a trillion yuan swap facility to lend money to funds, insurers, and brokerage firms to use to buy stocks. Now, keep in mind, in China, most individuals don't have the ability to invest in stocks. They created a 300 billion yuan relending facility given to commercial banks that would in turn lend the money to companies and other entities for stock buybacks. So China is essentially putting a floor beneath their housing and stock market. And if they're successful, could create more economic activity in the global culture. Chinese stocks are moving higher from this, as you would expect, as well as commodity prices. Bond markets around the globe are moving lower in price and higher in yield as it's being viewed as an inflationary step. So that has a big effect. China's number 2 economy in the world. They've been having significant issues with their economy, specifically regarding and related to real estate. Fed commentary had a lot come out today. Let's review it here. So the Atlanta Fed president, Raphael Bostic, said that he was in favor of cutting the 50 basis points because the uncertain trajectory of the labor market. So he kind of gets it, specifically within the labor issue. He also explained that the Fed can now slow down the size of rate cuts to probably a quarter point unless the labor market shows further signs of weakening, which we think there are even more underlying signs of a weakening labor market. If the unemployment rate gets to 4.5% or above, we do really think that the Fed's going to need to be more aggressive and quicker on these rate cuts. Chicago Fed President Goolsbee's been one of our doves, and we do like him. He's happy with where inflation is and the labor market is today. But if they want to keep things the way the Fed cannot wait, if they want to keep things that way, the Fed can't wait for problems to show up and get behind the curve. And if they want to avoid recession, they really need to stay on top of rate cuts. He said, quote, when inflation is coming in at the target and unemployment is where you want it to be, do you want it to be the tightest in decades? Question mark. If you're restrictive for too long, you're going to be at this. You're not going to be at the sweet spot on the dual mandates much longer. Unquote. So he explained that the Fed funds rate is hundreds of basis points above the neutral rate, and they've got a very long way to get it down to a neutral rate, or also referred to as the terminal rate. Almost all of the Fed members are citing great progress on inflation and worries about the labor market, except for our favorite Fed member, Governor Bowman, who was the lone dissenter on the September 18th meeting. She came out today and was trying to cover her tracks, trying to explain why she's such a hawk, but yet she just doesn't get it, and we'll kind of go into why. Um, she remains concerned that inflation is uncomfortably above the 2% target rate, which we've talked about. It's not really a mandate, it's a made up number. And the progress on inflation could stall. She said that low inventory and home prices are to blame, but those aren't included in the appreciation reports, home prices and appreciation. Additionally, she thinks the risk to inflation because of the labor market, which she sees employment as being near full employment, and cited that unemployment rate fell to one of the lowest rates, 4.2 from 4.3, but she failed to detail that the drop we had from 4.3 to 4.2 was a fraction, was a rounding issue. We actually came in at 4.23%, so only 2/100ths of a point from still staying sticky at 4.3. Yet she's also not talking about the weakness in the labor market, the lack of full-time jobs, the Challenger jobs report being weak, and also ZipRecruiter showing many more job postings out there than before, meaning a lack of employees. So inflation is not far from inflation's really not far from the target. When we take out shelter and motor vehicle insurance, we're actually under the target rate, and the Fed can't control those two. And Governor Bowman also talked about a basically historically low unemployment rate without giving context. Shockingly, not giving context because she doesn't have the background. She's an attorney and worked at mommy and daddy's bank. So it's not really the rate. It's all about the relative change, which we are now up 0.8, almost 1% more in unemployment from the cycle low. And the risk to moving higher is really significant right now. We've talked about it. The weak challenge, the more job cuts, the Challenger job cuts report that comes out, ZipRecruiter, the JOLTS report, and the BLS jobs and the ADP all being weaker than expected. So she just shows her lack of depth of knowledge and the context. So she actually has 3 interviews this week, I believe. So she's going to try to backpedal. She's going to try to do everything she can to make it look like she was the correct one, and she's the only one that dissented. Home appreciation, kind of quick over that. Case Shiller, which is generally considered the gold standard of appreciation records, showed that home appreciations increased 0.2% in July and we're continuing through record highs. Right now, year over year, we're up 5%. Now, keep in mind, West Michigan, we're generally much higher than that, being in a very stabilized marketplace. Additionally, what's really affecting us, in these non-metro, giant metro areas, non-coastal areas, is lower-priced homes are appreciating at a far higher rate than higher-priced homes. And that makes sense as there's greater demand in that lower to middle range. Now, keep in mind, that's nationally. I would say for us locally, what nationally they call low to mid range is really our mid-range, if not a smidge higher than that. FHFA also came out with their appreciation, showed that it was up 0.1% last month, 4.5% year over year. So very good numbers. Mortgage bonds on a technical aspect, a bit off today. We did test the 25-day moving average a little bit. We bounced off that. We're trying to claw a little bit of it back. 10-year bonds definitely reacted to the China news, and we remain underneath the 25-day moving average at 3.76. And, we stayed pretty stagnant in that for the last 2 days. But potentially the China news, PCE coming up at the end of the week, our market moving. Thanks for watching. Do us a favor, share, like, comment on this on all the socials. The Market Update Desk, Scott Riley, 616-293-2189.